Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser, and today it's been a couple weeks since we've done a video, so I just wanted to come in and give just kind of a quick update about where markets are sitting as we've closed out the second quarter. We're right in the middle of summertime earnings season, so it's a busy time as companies are reporting their earnings, more importantly giving their forward-looking guidance. So this time last year we were in a very unique situation where companies were beginning to come off of after being completely shut down. And so we were seeing crazy earnings kind of beating expectations because we went from zero earnings to significant earnings, or it didn't even need to be significant necessarily because anything greater than zero is going to show an exponential significant positive return. So that's kind of where we were last summer. Those numbers were a little skewed. It was a little difficult to kind of take that data and utilize it. So now, as we're coming into summertime earnings, these companies now, for the most part, have likely been open for the better part of a year, and so able to kind of begin to finally, see what it's beginning to look like on the other side. Thankfully, as we've seen things like vaccinations across the country, while kind of helping to assist with the additional kind of reopening, kind of getting back to the new normal, I guess, as we call it. And so I just really wanted to kind of show you, because we've seen a lot of rotation in the market over these past few months, because it was interesting, the areas that kind of rode us out of the pandemic, we saw some switches that happened, and we're going to talk about that. Now, some of those areas have kind of already recycled kind of their way back in, and then there's other areas that look like they could be possibly phasing out. So number one, we want to get into what we see in DALI, Dynamic Asset Level Investing. As a reminder, basically every day gives us a snapshot of all of the different areas of the market, all of the broad asset classes, as well as all of the sectors, as well as areas like commodities, fixed income, currencies. And basically all of these areas arm wrestle each other every day, and there's a winner and a loser. And then by using DALI and kind of looking at the trends, you can determine who is winning more and who is losing more. Those areas that are winning more are going to have a higher level of momentum, meaning that those are areas that will likely continue to be kind of drug higher. Areas momentum, they're beginning to stifle or go lower, areas that there might not be as much opportunity in. So that's kind of the idea here. So you can see within DALI, domestic equities is still far and away number one place to be. That being said, there's some specific areas. So top 1, 2, and 3, small cap and mid cap growth. Now this is a change from last month. Last month it was small cap value, small cap blend, then small cap growth. So, and it's been a while that we've seen one asset class, particularly small caps, be in the top 1 through 3 slots. So mid cap growth just recently kind of leapfrogged its way over blend and value, right behind small cap growth. And so I think we saw kind of this reflationary rotation back at the beginning of Q2, where we saw areas like technology and growth really got hit hard, and then we saw areas like financials and basic materials kind of move ahead. And so, the question was, is this going to be kind of a permanent change, or was this going to be just kind of a temporary rotation? Particularly because if you remember, inflationary pressures were really pressing on investors, particularly within the past few months. The idea that higher costs of goods is going to make it more difficult for some of these companies to be able to have higher earnings, to be able to substantiate these higher prices that we're paying. That's going to be particular in those large name growth and tech spaces. So we saw those areas really get hit hard. And so you can see mid-cap value, mid-cap blend, and then, so large cap, believe it or not, which was the area that for a long time was like number one, is still kind of sitting back with the laggards when we look at domestic equities as the asset classes. Although we've seen small cap begin to kind of start to lose some steam, because small caps were really just trucking along there for a while pretty dramatically. And so again, we're just going to have to see. It's kind of important to take this kind of holistically, we want to know the areas of exposure, but that doesn't necessarily mean that we're only going to put money in small caps, because we do want to make sure, we just want to kind of make sure that we're viewing it through the right lens. And then when we look at sectors, so consumer cyclical, that's been number one now for a while, that we really haven't seen any changes. Now what's been interesting is that, you know, financials and technology have kind of been arm wrestling. Technology was far and away the number one sector to be coming out of the pandemic. That's not really a big surprise when we remember those names that we kept hearing over and over again. Facebook, Twitter, Apple, those were all those names that we were just consistently, that were kind of like outperforming their indexes. And so when we look at these sectors here, it's, you know, energy, basic materials, industrials, and financials, they were part of that like rotation that we saw out of growth, out of tech, into some of the more like stable areas. And so the idea is, you know, is that going to hold or not? And so technology, though, has been able to kind of, it's recovered some. So this is likely going to be an area that for the long run will still be somewhat of a solid place to be. But again, just looking at Dolly, looking at just momentum right now, where we might want to consider being. And then just as a note, fixed income continues to kind of be at the bottom there. That would be the same, as well as cash is below there. You can't see that here. And then international equities is still in the third position. So just wanted to kind of spend a couple minutes just kind of on what we're seeing within the areas of the market itself, areas of strength that we're seeing, areas of potential weakness. And I just thought it was interesting to see these rotations that we've been seeing, particularly as it relates to, as we've seen things like inflation kind of come into the mix, as well as whether or not, you know, the other big thing is whether or not the Federal Reserve is going to begin to raise just rates in general. And if that were to happen, you know, what would that mean for some of these companies that have been able to borrow money for very inexpensive. So next thing, just want to talk a couple minutes here, just look at some of the major indexes, because we've actually, while we were able to kind of close out for the quarter with a fairly strong quarter, there was actually a fair amount of volatility. And so if we go back, let's just go back 6 months here. And so just show you, so you can see, now this is a small cap space, we violated our 50-day moving average quite often here. There was just a lot of choppiness in the market. And when you look at kind of like where we wound up and kind of like where we started, fairly close. So we actually didn't make a lot of headway. Every time we got like super elevated here, which corresponded with a higher RSI, and we had those little short-term corrections there. So the Russell 2000 was pretty sloppy when we go back these last 6 months. Same story with the NASDAQ, although it was a little more pronounced in terms of the declines that we saw. So back here in February, this was kind of like the top of the markets all across the board. And then as inflation really began to weigh, we just saw significant levels of correction. So the NASDAQ here really struggled from February, honestly, all the way into the end of May. And then finally, towards the end of May, we began to see it begin to kind of pick up steam, and kind of start moving in the right direction again. And really, though, ever since May, we've seen a really nice recovery for the NASDAQ. NASDAQ is going to be our more tech-weighted index. And so not surprising to see that our areas of volatility kind of correspond with all those other investor concerns that we've been talking about. So this is where we are with the NASDAQ, though. We've had a really nice recovery. I would not be surprised if we saw some sort of a short-term pullback in the NASDAQ at some point, just because we have had such a, and now we are so deviated from our moving averages here. And last, but certainly not least, the S&P 500. And so S&P 500 has actually had a lot of volatility this past week. So I'm not sure if you can actually see it too well here, but we've had some pretty days where we kind of started off and then we ended pretty negatively for the day. In terms of volatility, here we really just came and sat down on our 50-day moving average, briefly touched it and kind of bounced back up. That's the idea, that for the most part, moving averages tend to act as lines of support for the indexes. We've been able to eke out a couple of new highs for the S&P 500 within the past few weeks, and we've been able to hold them. So anytime that we're able to reach a new high, have a little bit of a pullback, and then go ahead and exceed it again, that gives additional kind of bullish support for the index. So we've seen the S&P has been able to do that a couple times over the past few weeks. Again, we've had a really nice run here up until this past week. It's been a little volatile. It's not unexpected. And something I do want to just make a comment of is typically in the summer, particularly the month of end of July, August, coming into September, tends to be a weaker time for the market. So don't be surprised if you start to hear things about, performance or negative returns within the market, or, red days or down days. It just happens. It tends to be the more volatile time. So that's just kind of something to consider. I mean, last year we had that 10% correction going into September and then again into October. But again, next couple weeks, the good news is that we've had some nice bullish support for markets within the past few weeks, especially being able to obtain new highs. And so just again, volatility is not abnormal. We expect that there are weaker times of the market, just like there can be strong times to the market. So it's likely that we're going to at least see some sort of short-term volatility within the next month and a half or so. And so the idea is that, we're going to continue to monitor the situation for our clients, look at those areas of relative strength, those areas of positive momentum. We want to make sure that we are kind of steering our way there, steering away from the areas whose momentum appears to be falling. And over the long run, that's kind of the way that we choose our investments and how we monitor our models. Again, if you have questions about your current portfolio allocations, whether you're an existing client or not, we would love for you to give us a call so we can talk about just what your current methodology is. You can always email me at ashleyer@victoryfiduciary.com. We're always happy to help. We're always happy if you have questions you just want to run by us. Otherwise, I hope you're really having a great summer. Stay cool out there. It's really hot here in New Jersey. So hope you can find a way to stay cool, stay safe, and we'll see you next time.